Good afternoon, everybody. Welcome. Thank you for joining us today. Are getting started, but I wanted to give a couple of quick housekeeping items as we do. Today's session is being recorded, and we'll send out the recording with additional content and resources following the webinar. So no worries if you miss anything. We encourage you to ask questions throughout. You have access to the chat as well as the Q&A and can use that to send in questions as you need to. I'd like to introduce our speakers here. As a reminder, the discussion here is general information only. So before you take any action, you should talk with your own advisor to make sure that you're thinking about what impacts your scenario in the most practical manner from that standpoint. We have Keith Carlson joining us and Josh Schiltz as today's presenters. Josh leads our valuation and litigation support practice at the firm and brings deep experience in advising private companies, legal counsel, and investors on complex valuation and forensic matters. And Keith leads the firm's mergers and acquisition practice with extensive experience advising clients on mergers, acquisitions, and growth strategies. He works closely with buyers and sellers and private equity firms to drive value across the transaction lifecycle. So with that, let's jump in and explore what's happening in the lower middle market and how you can stay ahead of the curve.
Awesome. Thank you, Jenny. If you wouldn't mind, yeah, that's great. Thanks for landing on that slide. Welcome, everyone, and thanks for coming to meet Josh and I, and then also kind of hear some current thoughts on what's going on in the marketplace with respect to mergers and acquisitions, deal making, valuations, especially with what we've got going on in the current headline cycle that's out there right now. And I thought we could start very briefly just by talking a little bit about the market conditions. And sometimes, at least in the world of mergers and acquisitions and valuations, it's sometimes to have a good basis of comparison. And from my perspective, there's no better place to start than kind of where my mind and I think our group's mind was to start the year. And for us, we turned the calendar year from 2024 to 2025 with a very, very bullish outlook on all things mergers and acquisitions, all things valuations, all things, liquidity cycles. Couldn't have been, more positive about the landscape that was setting up for what was hopefully going to be a really nice 2025 year. Another rebound year on top of a rebound year. Probably not seeing something like what we saw in 2021, but at least something that was very favorable. So that's kind of where we started the year. And as any good cycle of enthusiasm can happen, what we've seen is the political landscape and some of the policy rhetoric that has come out with respect to tariff has really turned a lot of things on their head. And
it continues to do it almost daily, Keith. Sorry to cut you off there.
No, that's all right.
But you're bringing up these challenges, and I'm reading through this, and I'm thinking about how it's daily. It seems to be a news headline of challenges. I would, from my side of the ledger, over on the valuation side, we kind of follow what you said there in M&A. We were all very hopeful that some of the risk that we had been measuring in the market was going to, come down. We were hoping that some deregulation would see some positive cash flows. And, as we sit here today, Keith, from a valuation perspective, when I look at what you were saying from the outlook to like where we're at now, I would say that I'm still concerned about what the current administration may or may not do with the tax rates. So, I think an important point that you're bringing up to everyone today is this is changing almost daily. I can't remember a time where there was so many headline potential challenges coming through like we're seeing right now. Sorry, but just wanted to highlight that point.
Yeah. And that's really kind of the moral of the story, and what Josh is hitting on is the volume of noise that is coming out, of the current administration is creating uncertainty. If you kind of look back, at least on the list of things that I like to reflect on of what was there at the beginning of the year that made us excited about the cycle that we were entering, many of those fundamentals, still remain today. You've got record amounts of PE. You've got lenders that are willing to put capital to work. You've got demand that has been pent up from both strategic acquirers and PE buyers. There's been subdued supply on the market of M&A transactions. And all those things pointed to what was going to look like a very extended cycle. But then you introduce uncertainty. And when you've got P&L uncertainty at the target assets that are the subject of either a valuation report or the subject of a sell side M&A assignment, and you certainly mix in some new things to kind of consider depending on what industry you're in. Denny, we can go ahead and go to the next slide. This is one slide here just to kind of show you the perspective. Not that CFOs rule the world with respect to what happens in mergers and acquisitions, but they are certainly a bellwether for the attitudes and the tones that their companies that they work in take on. And so one of the things that you can clearly see here to start the year is optimism was certainly trending higher going to the end of 2024 and into 2025, but we've seen a really abrupt downtick in terms of overall CFO optimism. And CFO optimism isn't just driving mergers and acquisitions, right? It's driving all sorts of strategic roadmap type items, whether it's to invest in new capabilities in their facilities, whether it's to hire new people in the plant, whether it's to think about laying off workforces. And so when we see this, it's certainly not a great indicator for a burst in the near term, both in the terms of merger and acquisition, deal completion trends, or frankly what you're going to see in terms of valuation spikes.
Yeah, and on the valuation perspective, we dealt with uncertainty just 5 years ago with the pandemic. For anyone out there who has a business or is valuing businesses, remember, uncertainty is not the same as a distressed business or an impaired business. To Keith's point, some of this optimism and how it came down is all these types of questions. And the questions that Keith is asking, or these CFOs are asking, these are the questions as a valuation analyst we're asked to answer. Valuation is an estimate of those future cash flows. Well, there's a lot of uncertainty on what future operations hold. We don't know if these are temporary or permanent, right? And so I go back to what we dealt with in COVID. We dealt with uncertain times. You're going to start probably seeing a lot of scenario analysis, hopefully, in valuations where we're looking at potential impacts on a discounted cash flow to see how that could impact the value, because the items that we thought were the likelihood and the materiality of those coming to the forefront are here in front of us. And so from a valuation perspective, this causes a lot of concern in how do we place a value on an asset when we don't know what's going to happen into the future. And I think those are, questions that are left to the valuation analyst. I would also say, and Keith, I would love to hear your thoughts, the management that can handle those questions or at least mitigate some of the risks coming from that. And we've seen that when certain management was able to take their PP funds and reinvest into the company as opposed to buying their yachts. When I see uncertainty, I start going, okay, talk to me here about the next 3 months. What does this quarter means for your business? How are you dealing with uncertainty? Is it just something in the news, Or how is this impacting, like a lot of things that I'm focused on right now, Keith, is how is debt impacting, right? And so did you have capital reserves? We're going to talk about some industries that are having some direct impacts, not only to them at a public level, but then downstream to the private company. And when I think about disruption, which is what I kind of labeled anything that can put a bounce in a business, how do they respond from disruption, right? That's what we're looking at right now. So I would tell any business owner out there or anyone that the measurement is happening right now for folks like myself. We're going to look at this historical information, much like we're going to look at the historical information if your company was around during COVID and see how you handled that, with or without PPP, to assess the viability. Right now, Keith, a lot of times, and we've talked about it, you're just looking at numbers and valuation, but management's ability to stress opportunity, to mitigate risk, those are all going to come out as this phenomena is happening.
Yeah, no, it's a good point, Josh. And from my perspective, one of the things I've kind of learned over the last 20 years of doing deals in the lower middle market with respect to valuation is valuations tend to be much less volatile than the considerations paid. And so where we see a lot of the volatility and the swings up and down aren't so much on the purchase price multiples. Maybe, 1 year we see purchase price multiples in the 7.5 to 8 times range on lower middle market companies on average. But what could change year to year very dramatically, especially in a period like this where we've got unknown P&L impacts on a potential target, is how a buyer will convey the payment for said valuation. And just for perspective, everyone on the phone, if you go to sell a business, odds are very likely they're not going to give you 100% of the value in the form of US cash, right?
Yeah.
It's going to be in the form of seller notes. There could be earnouts, there could be equity rollovers. And so what I am banking on this year is, not to fast forward to the answer, but what I am banking on this year is will we see some dip on valuation trends? Probably, most certainly, especially depending on how the debt markets, eventually trend out from here. But I think where we'll see the most volatility is the days of the 80-20, 80% cash, 20% other consideration paid for a potential company. You're going to see that swing much more in the favor of the buyer, in that they'll be able to put down 60% cash, 70% cash, and then they'll also be able to take that other component and then slice it up. That is much more heavily weighted towards the earnout payment, which is tied to contingent performance. Like, hey, you tell me, like to Josh's point earlier, you told me that regardless of these uncertain times, your company was going to continue to produce X amount of cash flow. Well, by golly, if it does that, we'll pay you this portion of the purchase price.
Yeah, no, that's a great point. I didn't even think about it. And as I talk to clients, I think a lot of them have the kind of that, I'll call it PE hangover for the last 3 or 4 years, where they were getting those types of deals and the cash was as prevalent. But to your point, these are strategic buyers. They're not going to risk their capital. They're going to have incentives into there, right? And so, that almost brings up a good point for the sellers or the potential sellers on the call today is, where are the hidden levers within your business? Where does one see risk, but you see opportunity? Those are the questions when I get into value a company that I want to be able to see management articulate, right? And I don't want to see something canned. Like, I can tell when somebody's been prepped by Keith, as opposed to you have real management in place who is saying, yeah, we dealt with this issue. This is how we dealt, this is what we did operationally, financially, strategic from that. And so, you're going to have, I guess, Keith, when I hear you say that and you tell me if I'm off base, it sounds like you're going to have to do a better job in polishing up and selling what the subject is capable of, because this hangover of uncertainty is a real thing, right? It's the 30,000 pound gorilla that everyone will start any deal conversation with, right?
Yeah, similar to your story when our group was, taking companies that sold for 2.5 to 3 years subsequent to the COVID period. You had to basically demonstrate why anything positive whatsoever in your business wasn't directly attributable to what we call the COVID bump.
Yeah.
Whether it's increased consumer demand or you took advantage of a supply chain shortage, whatever it was. And so it's an excruciating process for a company and their sell side advisors to go through, but
Mhm.
you certainly have to do it to demonstrate all the things that Josh is mentioning. Thank you, Jenny, for going to this next slide. Kind of what you're seeing here on this page is really an up to date through end of April snapshot of mergers and acquisitions. And what you can see here is the top light blue shaded box is U.S. mergers and acquisitions, and really the bottom chart or the bottom dark blue is the rest of the world. And what is really the big takeaway here is what many thought was going to be a very big breakout year in the United States has fallen a little bit flat, right? So through the first 4 months, we're 587 billion of U.S. M&A right now, which is still a very big number when you compare it to some of these rest of world figures that are floating around out there. But it also pales in comparison to what we saw for the first 4 months of 2022. And I think 2021 is an outlier. It shouldn't be used for comparisons for anyone just because of what occurred. And so it's tepid. I think it's the best way to describe it. And frankly, I think it'll be even more tepid if we were to break this out and look at it for the individual months. I would venture to guess, and I haven't looked at it. Year started out strong probably, and it's swiftly deteriorated very quickly. And frankly, until there's known policy stances from the current political administration, I think people are going to be hanging tight. Only the brave are going to be out there, doing deals, or certainly the non-brave will be doing them in ones they're absolutely crystal clear. They're either getting extremely good value no matter what happens, or B, they're banking on an industry that has little to no impact as a result of the tariff policies.
Yeah. Speaking
Um,
of those industries, like Keith, the industries that I'm dealing with, and obviously I'm not dealing with, I'm not valuing General Motors, but automakers, retailers, healthcare and med tech, especially down here in Northeast Florida, consumer goods, electronics and gaming. Those are the ones that are being hit, right? It's the supply chain disruptions. So if I'm a global business or if I'm buying and selling and I rely on that, okay, that's my answer. This is what I'm stuck with. My question is, are there alternatives? No, there's no alternatives. Do you have a plan in place for alternatives, right? And when we look, so from a private company valuation, I understand that General Motors, Stellantis are dealing with things. You got J&J that's going to have their issues in healthcare. How does that boil down? Because in private companies, the private companies are a lot of the suppliers and vendors that are situated underneath these public companies. So going back to what you're talking about, industries, these are the industries that in my world and valuation, we're starting to look at and go, we're seeing direct impacts to them from the tariffs. And the direct impacts, Keith, are going to be specifically in working capital, the cash turnover, receivables turnover, and then how are we managing inventory, right? And that's where, to you, like you want to look at this on month to month. I'd like to look at it almost month to month on a subject company. As these policies change, what happened to the working capital? Because I should start to see when the 145% China tariff went in and my inventory's hung up there. And so we're starting to hear stories about this when we talk with clients. It'll be fascinating to see how this impact, we're always looking at history to predict the future. I'll be honest with you. I think a lot of this disruption Again, sounds familiar. Supply chain disruptions. We've been through this. And so
Yeah.
when I'm looking at businesses, and it wasn't that long ago, Keith. So unless you got a new management or you're in some startup, you better have a game plan. Otherwise, what are we doing? To your point, I think that's where there's some deals, because you have somebody who's running a Ferrari and doesn't even know how to drive a manual.
Yeah. Yeah. No, you're venturing into some topics that I haven't let my mind wander to yet. The working capital one will be fun to watch, all the pro forma analysis to going back and applying, you know, 145% tariffs to the prior 9 months of inventory to see what it would have been. But yeah, lots of interesting consequences. You're right. Fortunately, there's some fresh scar tissue in our not too distant future, which we can call upon to deal with this. And I think buyers will have the same feeling. They'll be like, hey, new situation, same type of dynamics that we could kind of touch on to go back to our COVID days. This next slide just shows, that's based off of a CFO survey. Again, CFOs aren't the end all be all, but you can see what's dominating their minds in terms of what concerns them, right? If you kind of look where it was in Q4 2024 to where it is today, trade and tariff is absolutely dominating the mindset. And if there's one thing I know to be true, the level of mandates coming down from CEOs or ownership to scurry around and figure out what the impact is to us, and not only figure out what the impact is to us, but start to figure out and remap your entire supply chain, all for something we still don't know to be certain at this point. This is what is preoccupying a lot of our CFOs' times in the world today, because frankly, most businesses out there in our country, statistically speaking, are impacted by whatever happens, if anything. We think it'll be something, obviously, but what happens, to the P&L and balance sheet when and if the tariffs come down and get cemented in a slightly more adversarial way than they are today.
Yeah, and it's really making, my team and us think about those, Keith. And that's what I was talking about. One of the things that I started doing, and I would tell any company, I think it's a really good exercise, is when you're doing your projections, do black swan analysis, right? What is the worst case scenario? What does that mean for my company? What's the likelihood of that happening? A lot of analysts during COVID would run kind of a high, medium, low in terms of risk of that DCF, right? And they were trying to understand where you fell in the risk profile at certain points of times. But I think it's interesting that, as we're sitting here talking about what's stalling some of the M&A activity, what's stalling it is we have questions that are left unanswered, and we can't answer those. So how do you manage your business when you're unable to have any definitive kind of roadmap, especially in regulations? And so, as business owners, you're left to kind of just jog along. And from a valuation perspective, and I'm assuming, Keith, it's even more on your side, well, if you're left to jog, you can't talk about what your plan is to grow. It's just unfathomable right now, because I don't know how much it's going to cost to get the ship out of the port down there in Fort Lauderdale. So when you talk about geographic expansion, when you talk about all of those things, which I think was a big part of PE roll up, it's a big part of M&A. It breeds, the combination of business assets. We're not focused on that right now. Right. And that's where I get concerned in private company, not just from valuations, but then from innovation. How long does this stall? How long does, and here's the other thing, and this is not to offend anyone. The fact of the matter is the people that run Royal Caribbean Cruise Lines, they're professional managers. They went to Wharton School of Business. A lot of people, myself included, that were running their small business were not that. And we also don't just wear the CEO hat. So when you compound that, with the uncertainty, that's where I get scared that people make mistakes. And the next thing you know, you have a company that looks like it was distressed, which is just a temporary thing. Distress is okay. Look at the global financial crisis. Who wasn't distressed? But it's the permanent when you become impaired. Those decisions that could lead to permanent, right, impairment to your business. And permanent means that basically your book value is higher than anything out in the market value. And there's a lot. That's what I think business owners, advisors need to be aware of. We're living in it now, right? So as I'm living in it now, how am I managing the risk?
Great points. This next slide, this is going to be a little bit like beating a dead horse, but this was alarming to me as we were putting this together. I certainly, you know, I've been doing deals for most of these periods where there's been spiked uncertainty. What was alarming to me was to see levels of United States and global uncertainty reach levels that certainly rival the COVID-19 pandemic and exceed the global financial crisis and 9/11. So that obviously we could dissect the survey that was taken. We could, say who responded and who didn't. But that was alarming to me. Like just to kind of get a sense for real world uncertainty measures with respect to where we are today. And when you have this level of uncertainty, it just speaks to and dovetails into everything Josh and I have been saying about the current climate that we find ourselves in. But interesting nonetheless.
It's also interesting, Keith, in that there's some economists that would argue to add a gray bar to January of 25. There's some people that would tell you we are in a recession. And so I find this slide interesting in that you got the street saying one thing, right? But now I'm starting to look at this data right here, and if anything tracks like it should, we should be in a recessionary period, right? I think the difference about this is it's uncertainty in the form of regulation and policy, right? As opposed to catastrophic events that happened and you had to rebuild off of. And so that's what worries me is, to your point, I remember the global financial crisis. And when I compare that to 9/11 and COVID-19, that was probably much more uncertainty than those other two. Although COVID at the beginning, it did feel like we could be living by ourselves for the rest of time. But I felt like in the job market, I remember I'm like, I'll never buy a house back then. And as we sit here now, I would say uncertainty is matched, if not higher, because it's one thing to be uncertain, but it's another thing to be uncertain for an extended period of time. Because I do know this, the mind starts playing tricks on you. And as you sit in that uncertainty, what are you doing about it? Like, that's where I have concern. Just a side thought there.
Yeah. So the next slide is really a kind of mine and Josh's view of, given where we are today in this environment, what are buyers, sellers, and lenders doing? Because this is obviously the holy trinity of what drives the M&A cycle. It takes three to tango. And what we're seeing from the buyer community so far, and we are in such early innings to really call the ball and say, hey, this is what's going to be occurring for the next few months. But we're seeing larger sponsors continuing the trend of prioritizing their bolt-on or add-on transactions. The level of due diligence that occurring is rivaling what we saw during COVID, to Josh's point earlier about people not overanalyzing, but putting a lot of scrutiny into variables that maybe this time last year were not being scrutinized. They are looking for industries that are not exposed to anything related to tariffs, or if they are exposed, some type of minimal exposure. And what you're seeing on sellers is a lot of the conversations that started, this time last year and really into the later parts of the year, where they perhaps were gearing up to sell their business. They're having tough conversations with their M&A advisor about, hey, what does this climate mean now, and what are the revised projections? If you take my company to market today, what does it mean for me in the marketplace? And those are unfortunate conversations that any M&A advisor or any evaluator's got to have, as markets change quickly. Valuations can and do come down. And like I said earlier, the considerations paid with respect to how a buyer is going to pay you for your company, it's changed a little bit since since we were at the end of last year.
Keith, going back just real quick, just so everyone's aware, back to your slide on like where we were at the beginning of this year and where we're at now. When we value a company, we measure the cash flow and we capitalize that with a discount rate. Well, one of the components in that just went up from 5 to 5.5. So in terms of risk, it's already increasing from the publishers when we're looking at our discount rates. I say that because you could have the same cash flow last year as you did this year, and the value is lower just from that one variable.
And then the third pillar on this page, the lenders, they track closely. They track closely, lenders do, to how buyers behave, and so they're certainly tightening their lending standards, and they're looking at the same things buyers are, which is, hey, what's my post-close risk profile on this particular asset, particularly as it relates to 2024's earnings or 2023's earnings. Like, what does this new tariff impact do to this company if and when, the worst case event occurs with respect to tariff policies? And, because of that, I think you're going to start to see some very cautious decision making on their part. There's going to be industries that they're willing to participate in, some they're not going to be willing to participate in. And I think you'll see just a broader pullback, not a severe pullback, but a broader pullback on their appetite to lend at levels they were lending at last year. And if there's one thing I think Josh and I can both speak to, when you're running models with levered returns, which, if you look at the private equity community, or if you look at a quantitative way of approaching valuation, leverage can and does help a lot of these buyers in their ability to pay higher for a certain asset. And the moment you start tugging on the lever of availability of debt for transactions, or what that debt costs, valuations come down. And the opposite is true too. If lenders are lending more plentifully, or the cost of capital goes down, guess what happens? Valuations can go up because buyers can afford to do it, especially the return conscious investor that's targeting a certain, annualized return on their deals. And that's, for what it's worth, that's 50%. In some years it's 50% of the buyer community in the US, and other years it's a third. It kind of goes back and forth. But when that much of the buying population is dependent on some form of credit capacity and cost of credit capacity, this is a huge variable that you've got to keep your eyes on when you're talking about, hey, what's going to happen with valuations this year. So if I'm calling the ball, which I think it's a prognostication at this point, I think it is safe to say that there will be some lending hesitation. Lending won't be as ample. Costs are another manner. I don't necessarily see those going up from where they are today. Ideally, they continue to come down depending on where our Fed shakes out on their policy.
Yeah, those are all really interesting points. I just so everyone, when you're out there, whether you're buying, selling, interested in businesses, there's 6 questions I think everyone should be asking themselves about a subject company. Obviously, how does the tariff and other policies? Remember, the tariff is one policy. So, as hopefully many of you know, Dean Dorton is now located in Florida. We have a large construction industry, roofing contractors, you name it. The immigration policy is impacting those businesses. Workforce shortages. I was reading some ungodly percentage, Keith, of workforce shortages hitting landscaping, maintenance companies, roofing, all those construction. So how does the tariff and other policies impact your cash flow, your debt, right? How does this impacting your debt, your ability to fund, which goes back to what debt you have? Is there a tax impact from this? Does the company's balance sheet, pre-policy I call it, I used to call it pre-COVID, have an impact on valuation? So I like to look at a strong balance sheet. Earnings are nice. What you do with those earnings in terms of investing, financing, and operating is what I'm critical of. Was your balance sheet prepared for an uptick in 25? Why were you running thin? Those are questions. Is management, and I've talked about this enough, is management competent enough to recover? Is there a formal plan? Keith brought up in that previous slide, there's opportunities for bolt-ons. I think under a situation like this with people trying to exit, I can see a situation where there's deals. How is your competition faring? What are you doing? What's your competitors doing? Granted, you might be a $5 million business in bottle distribution, but what is Coca-Cola doing and how do you compare and why not? And then another thing, and it's important in valuations, what has this done to your intangible assets? How is your workforce faring? How is your brand, your trademark, whatever intangibles you may be? So, just some additional questions you as a business owner or whatever side of the table you're on, you might want to consider when we're dealing in such an environment.
Josh, we had a couple of questions come in around the uncertainty in captive insurance. I'm going to paraphrase quickly, but are buyers viewing captive insurances as a way to hedge against future downsides risks, or are they being positioned as tools to mitigate the valuation shocks in the unpredictable environment?
So the captive insurance market, and Keith, feel free to jump in. I got my education in captive insurance when I worked for the largest state insurance company in the country down here. It's a secondary risk mitigation tool, to the point of the question. My question is, how much is that insurance? And then number two, and you'll have to forgive me, a lot of it from the captive side, I fall into property insurance. How well funded are some of those captive companies, which is a concern that some of us have. So yes, insurance is always nice, right? I guess, what are we insuring against? Some of these things from an operating characteristic, I just don't know if you can insure against them. I don't know if you had a different take on that question, Keith.
No, I mean, honestly, captive insurance don't even register into the conversation with really anybody. So
I'm trying to be imaginative. Yeah.
No, they don't. Maybe they should. Maybe we need to go out and learn some things about captive insurances. But for my perspective, it's a non-factor. But on this, just kind of moving along here, because we've got a few slides to continue to work through. One of the things that's interesting about the lower middle market, and for some of the folks, particularly at Dean Dorton, that are somewhat newer to mergers and acquisitions, that haven't ridden the cyclicality that comes along with cycles that we sometimes go through in valuations and M&A in general. The one thing that the market can't outrace is father time. Okay. And when you look at the merger and acquisition landscape in our country and you see the volume of deals that get done with non-backed, or what we call family-owned businesses, which is 50% or greater in most every single year, Usually it's larger than 50%. Usually when you're looking at those companies, there are reasons that they are selling that have nothing to do with timing the market, right? They don't read the Wall Street Journal
This is
or,
the
you
world
know,
I live with, Keith. Yeah, these are my clients. Yeah, they're just getting old. They're done.
yeah, and so from our perspective, we could prognosticate about, what are going to happen to valuations, what are going to happen to considerations paid. Most of the people coming to market with a transaction in the lower middle market, it's fair to say they haven't studied past historical cycles enough to really have formed a strong opinion one way or the other about the current landscape that we're in. And so Josh and I oftentimes find ourselves, dealing more with the emotion of selling or dealing with the emotion of what the valuation means to that family, as opposed to a family saying, man, I really want to time this market, and I want to sell on top. There's a few that come to us and certainly have that on their mind. But it's
You
the
just hit
minority.
on I think a really important piece, Keith. There's a lot of birds out in the ocean right now, in that you have this economic uncertainty in the tariffs. But at the end of it, on the other side of the table, is we have a plethora of family-owned businesses that are owned by baby boomers who have not gotten younger in the last 5 years, who missed out on the PE bump and are now sitting here facing 70, 75 and going, what do I do? Right? I mean, we can't stop that train. I mean, when you look at the demographics of this country, that is the largest concentration of wealth and the workforce. And so it's fascinating from an economic sense. Somebody would say I'm nuts for saying it's fascinating, but it's fascinating when you see all those competing variables converge, right? And that's, to Keith's point, that's the pressure that pushes on him. You got a client who wants to go to market because they're 73 years old and they've been doing this for 45 years. And Keith is saying, we better wait a year or two. Well, my wife is not. So there are, and that's where I was trying to talk about earlier, is what is your differentiator as a seller? I think, to Keith's point, there's going to be some deals out there. How do you separate from the pack?
Yeah. Next page, Jenny, if you don't mind. Thanks. We're not going to go through these in any degree of detail. This is just our thoughts in terms of the fundamentals that support the market. And we've already touched on many of these. Like the same fundamentals that were in place to start the year. Lots of capital with PE, flush balance sheets with strategic acquirers, ample credit capacity, debt prices coming down, valuations being reasonable, all set the stage for what was going to be a really big year. Those aren't going away, right? And so I think, and I'm kind of racing to the end here, and we'll touch on these again. I think when you've got that kind of landscape, as soon as the one variable that is causing some leakage in this M&A cycle, which is certainty versus uncertainty, once that flips from uncertain to certain, these fundamentals will drive an unbelievably strong M&A cycle. Okay, and that's I'd kind of note this point in time, not knowing how long it's going to exist. And to Josh's point earlier, one thing that's troubling sometimes is the length of time for which someone sits in a very uncertain position, provided that we're in a relatively short window. Maybe it's at the end of the 90-day window that was discussed during the I forget what the phrase was for the holiday that the president
Liberation
granted.
Day.
The Liberation Day. And to the 90-day window that we're in, perhaps when we get to the end of it, all variables are known, they're locked in, and this cycle starts to regain its steam that we all thought would be there at the end of the year. And that's my hope for the rest of the year.
I mean, on that point, there's only two ways to this street, Keith, right? I mean, we either stop the tariffs or we continue them for the foreseeable future. I think the market will rebound okay, to your point, once they know the path they have to go down. It's just the not knowing right now that makes everyone go, how can I make a financial decision when it's just not known? It would be unresponsible, irresponsible,
Yeah.
excuse me.
Yeah, and that's why, kind of back to the consideration point, with those that have a compulsion to sell now and buyers that have the appetite to buy in the unknown environment, the tools that will be in vogue this year until we get certainty are going to be the earnout. It's going to come back in a raging fashion, and you're going to see it in a lot of transactions, much to the chagrin of advisors and sellers alike, because I think the the biggest dreaded hyphenated modifier word in the world is the earnout.
Yeah.
And people don't love it, but if you want to get a deal done, that's certainly where you're going to have to put your put your heart and mind right squarely in that payment consideration if you want to get something done. This next slide here, you're already starting to see a little leakage, and before I kind of go into this with any degree of detail, this is for all M&A transactions, with exception of, let's call it the one on the left hand side. Actually, we've got three different graphs here. The one on the left hand side is for under 2.5 billion. The one in the middle is on PE deals below 25 million, and the one on the right is basically all deals. So we're giving you three different takes. They all show the same thing. Okay, and that there has been a little bit of a downtick or deterioration in multiples that are being paid relative to where they were in 2024. No surprise. If, like we've been saying all along, if you want to get a deal done this year, there's some trade-offs that you're going to have to make. Valuations a little bit down. Considerations are going to stink. They're still good. It's not to say that they're bad. They're just not what they were, and it's all relative. And again, going back to the Father Time statement, if you don't have a relative standpoint, odds are most of the private business owners that Josh and I know, 0.2 times on the EBITDA isn't going to be what makes or break their retirement plans.
No, not at all. A lot of the small business owners are worried about their staff and the future of them. I agree with you. That's why, to your point about consideration, Keith and I were talking about some other financing situations this morning that people are getting creative. But, I heard hope in what Keith said there. I heard, and I think not to just because he's my business partner or anything, but I do think he's right that when I look at the dry powder, when I look at the engines that stir economic activity, everyone's been waiting to get out from the COVID slump and all of those things and really start saying, okay, we're past all that, blah, blah, blah. You have to believe that once we get some certainty on some of these policies, to Keith's point, we're going to start seeing that activity really pick up. And I don't know if we could go, but I bet you if we went back to that slide where you had 9/11, 08, and the pandemic, I mean, I can remember the pandemic, the preceding periods were some of the best ever in terms of volume and price.
Yes. Yeah, 2021 will never be rivaled
No.
on mergers and acquisitions in the United States. I don't know if we'll see it again in my lifetime. I think it would be fun to see it again. That was a fun time. But I do think there'll be a lot of pent up demand once we flip the script because of everything we've already touched in. Capital.
Yeah, and hopefully people are realizing that, yeah, you got to run your business, but this uncertainty, you should be preparing for this, not just for running the operations now, but then showing resilience. These are things that when Keith talks to buyers and sellers, that's that special. So it's a good time to kind of rethink where you're at right now too, to Keith's point on when and if we get out of this, it will be ready to go.
The one thing I'll touch on here, and I know we're running close to the bottom of the hour on time. The one thing I will touch on is for all the kind of doom and gloom that we've come on here today with respect to valuations and deal appetite and credit capacity and all these different variables that impact M&A. If your company or a company that is interested in selling that has low or no impacts relative to tariffs, the one thing our group is absolutely seeing right now on the merger and acquisition side of things is unbelievable demand. Okay, and this Josh and I have ridden through a couple cycles. I think this is probably more akin to the cycle that would have been back in 2009, 2010, when people were running away and fleeing, all the building products companies. Nobody wanted to touch anything related to building products because of what was going on in our national housing crisis. New homes weren't being constructed. Remodels all but froze. Lending to those situations were on fire. Nothing was happening. But what happened in those periods is anything not touching, the building product sector got white hot, like absolutely white hot. And all the buyers gravitated. It was a flight to safety in their minds. They gravitated to those assets for a hunger to get their capital deployed, to do transactions, but to seek an industry that wasn't as exposed to the risk. I am seeing this in real time in our group right now. We've got a couple companies that are absolutely not exposed to anything having to do with tariffs whatsoever. And our group has received record inbound indications and letters of intent with respect to those assets. And the valuations have frankly blown our mind. And so if you are in this market and you are in this period of uncertainty and you can solve certainty for a buyer, you are in the catbird seat.
I agree.
And this last page, really, kind of sums up a lot of what we've been talking about today, in terms of where we are today versus where we were at the end of last year, and frankly, where our group sees it going by the end of the year. I'd say debt environment. You've got some tailwinds that exist today that weren't there at the end of 2024. I think there's going to be some industry-specific pullback, and we certainly see that improving by the end of the year. Ideally, as cost of capital improves, depending on what our Fed does. PE dry powder, a lot has been made about, the fundraising cycles being slightly depressed, in the last 12 to 24 months. But the truth remains that there is there is a lot of near record amounts of dry powder that are sitting on the sidelines. Deal flow, where we are today in our environment, it is scarce. So if you have a deal, it's in the market, there's going to be a lot of buyers that are chasing it. That supports valuation trends in the favorable to the seller. If you look at the uncertainty, that's the push down effect. Josh actually mentioned something earlier about tax policy. Clearly, I'm a little blinded on that particular topic because I haven't heard anything that has kind of crept into my stratosphere at this point. But to the extent that there are new policies that come out, that could obviously have a natural impact on valuations as well. Very similar to what we saw in 2021 when Mr. Biden was threatening the capital gains regime that was in place.
It's really the corporate tax rate that we're concerned about because that's what drives the discount rates in the public markets, Keith. So yeah, it's the cash flow associated with the risk and the taxes, the input in there.
Yeah. And then last but not least is strategic buyer behavior. As much as we've talked about private equity buyers, strategics being on the scene and lurking in the shadows on these processes to buy companies, clearly very important. We see a subdued interest, for the next few months as we ride through this wave that we're in with the uncertainty. But I would, again, reiterate what we've already said time and time again. I expect that to rebound with a fever pitch towards the end of the year, provided that we get certainty around tariff policy. Yeah, and just quickly, I think Jenny did a nice job with our summarizing our groups. I think she's going to send out presentations later so you can grab all of our contacts. Feel free to reach out to Josh or myself, or frankly anyone on our teams, to chat anytime that you have questions. And both Josh and I are fluent in our different sides of the aisle. So if we find ourselves in a part of a conversation where someone's asking me something specifically about valuation, I'm very good at ushering that person to the door. So
we're regularly call upon one of each other. Keith does, and his team is great in the nuances of, the art of the deal, and helping me and my team understand some components. And, we can do our bean counting in some of the ways that augments them. But it's really nice to have cohorts in your own firm that you can turn to, that are seeing different things in the transaction side, different things on the valuation side. And as you guys can see, we like to bring that together. And really, it's okay, here's the problems. Clients are facing these problems. How do us as Dean Dorton as a team help solve those problems? And we've been able to do that, and we're getting better at it.
Any questions that we didn't hit on already?
Looks like we got everything and we came up to time. Keith, awesome, just really great information from you and your group. I know as we were talking about it, it's stuff I'll be sharing with my valuation cohorts. It's interesting times.
Yeah, you as well, Josh. Appreciate all your input and collaboration here.
Great. And if anyone has questions, feel free, like Keith said, reach out to Keith or myself or one of our team members. We'd be happy to discuss whether you're a buyer, a seller, or wherever you are in the transaction.
All right. Have a good day, everybody.
Take care, everyone.